Welcome to the Daily AI News Digest. This broadcast, our Daily Explainer, is sponsored by bestai.org. Today is June 26, 2026, and we're analyzing a market that is undergoing a massive structural shift. From custom silicon developments in San Francisco to a newly expanded 35-nation alliance in Washington, D.C., the era of simply building software is evolving into something much more complex. So let's look at today's market realities.
On the Explainer agenda today, we are tracking a few major headlines. Reports indicate OpenAI is delaying its public debut until 2027. We're also seeing a significant tech sell-off hitting global markets. Plus, OpenAI and Broadcom just unveiled their custom Jalapeño inference chip. And finally, the Pax Silicon Alliance expands to 35 nations to secure global AI supply chains. Let's dive right in.
We'll start right here with this number, 12.5%. That is the sudden plunge we saw in SoftBank Group stock in Tokyo trading today. The catalyst for this drop is a New York Times report stating that OpenAI is holding off on its initial public offering until late 27. Look, SoftBank's valuation has been deeply anchored to CEO Masayoshi Son's bets on the AI ecosystem and his close ties to OpenAI. This delay is a clear signal to investors. The timeline for actually seeing liquidity in these frontier AI companies is stretching out much further than the market previously modeled.
And we have to understand that this market correction isn't an isolated event. Over at Alphabet, we saw a staggering $270 billion wiped from their market capitalization. That marks their worst day on the market in over a year. A core driver of this institutional anxiety is talent flight. In just a 6-day window, Google DeepMind lost 4 senior researchers to their rival Anthropic. That includes Nobel laureate John Jumper and Jonas Adler, all 4 of whom worked closely together on AlphaFold. What we're seeing is the market pricing in a harsh reality. Retaining elite AI talent is no longer just a human resources issue. It's an existential operational cost.
This volatility we're tracking is structural. The tech sell-off hit global indices hard today. Yes, the Nasdaq closed down 2.2%, but the real impact materialized over in the Asian markets. South Korea's Kospi plunged 5.8%, which actually triggered market circuit breakers. The Nikkei in Japan shed 4.15%. This extreme localized volatility in Asia is directly tied to the performance of AI hardware providers. Samsung shares fell 5.3% and SK Hynix fell 8.4%. Right now, investors are heavily questioning whether the massive capital expenditures driving these hardware rallies are actually sustainable.
Moving over to product and model realities, we're seeing a very clear signal toward vertical integration. OpenAI and Broadcom officially unveiled their first custom silicon partnership today, giving us the Jalapeño chip. Now, to be clear, this is not a training accelerator. It's purpose-built strictly for inference. Manufactured by TSMC, the operational target here is a 50% reduction in inference costs per token compared to current generation GPUs. When you consider that OpenAI spent roughly $14 billion just serving ChatGPT in 2025, slashing those inference costs in half becomes a major profitability-defining lever for the company. They're slating prototype scale deployment for late 2026.
On the software side of things, prediction markets are heavily favoring an imminent release of GPT-5.6. The internal code name for this model is kindle-alpha. Looking at the leaked parameter updates, we're seeing a 1.5 million token context window and some significant upgrades to long-horizon agentic coding. Crucially, the update includes a redesigned reward audit pipeline. That's meant to fix the documented Goblin incident, which you might remember as that miscalibration in GPT 5.5 that resulted in excessive metaphorical language outputs. However, the Trump administration has reportedly pressured OpenAI to limit this rollout to government-approved partners, citing national security concerns over the model's advanced cyber capabilities.
Now, this government pressure on proprietary models comes at a very critical time, largely because open-weight alternatives are rapidly closing the capability gap. NVIDIA's Nematron 3 Ultra brings 550 billion parameters to the open ecosystem. Meanwhile, challengers like Minimax M3 and Zippu AI's GLM 5.2 are now offering 1 million token context windows, with a very strict focus on agentic software engineering. The cold business reality is that the operational distance between those proprietary, heavily regulated models and the freely available open-weight models has never been narrower.
Governments are, of course, responding to this shifting landscape. At the Pax Silica Summit in Washington today, U.S. Undersecretary of State Jacob Hellberg summarized the current diplomatic pivot perfectly. The Pax Silica Alliance has now officially expanded to 35 nations, adding key players like Germany, the Netherlands, and the European Union as a whole bloc. Make no mistake, this is a highly coordinated macroeconomic maneuver. It's designed to build resilient, trusted supply chains for semiconductors and AI infrastructure, explicitly aimed at reducing Western dependency on centralized, non-market economies.
To ground that policy in some cold economic data, right now, China controls the refining of 70% of global strategic minerals. That includes critical rare earth elements like neodymium and dysprosium, which are absolutely essential for advanced manufacturing and tech hardware. So the Pax Silica initiative isn't just some political statement. For these 35 allied nations, securing the physical materials required to sustain long-term AI development is a strict industrial necessity. But while international supply chains are consolidating, domestic AI policy here in the United States is rapidly fracturing. In the absence of sweeping federal legislation, individual states are aggressively stepping in to fill the regulatory void. Just today, Rhode Island enacted a complete ban on AI therapy bots. Colorado recently passed SB 26189, a law focusing heavily on automated decision-making technologies and mandatory consumer notices. Meanwhile, New York has 7 separate AI bills sitting on the governor's desk awaiting signature, covering everything from kids' chatbot safety to training data transparency. For the enterprise developers and founders listening to this broadcast, this is the reality. You now have to navigate a highly complex 50-state compliance patchwork.
The federal government is attempting to respond. Back on June 2nd, the Trump administration signed an executive order aimed at promoting AI innovation while simultaneously addressing security. The timeline establishes a 60-day window to design a voluntary framework where developers can consult with the government. But perhaps more notably, it introduces a 30-day pre-release review period. This allows the government to access covered frontier models before they're deployed to other trusted partners. So it's a framework built much more heavily on voluntary industry collaboration than on strict prescriptive regulation.
The legislative branch, however, is proposing a much more forceful solution to this state-level fragmentation. The Great American AI Act of 2026 is a 269-page bipartisan discussion draft. The most significant mechanism in this bill is a proposed 3-year sunset on state-level AI regulations that would effectively preempt those localized laws in places like Colorado and Rhode Island. In exchange, the bill establishes unified, binding national standards for large frontier developers, which it explicitly defines as companies generating over $500 million in annual revenue. That directly targets the operations of players like OpenAI, Anthropic, Google, and Meta.
All of this brings us to the core macroeconomic dilemma currently facing the tech sector. Projected capital expenditure for AI infrastructure in 2026 is rapidly approaching $700 billion. As companies take on billions in debt to fund all this computing power, market patience is visibly wearing thin. So, the question driving today's market volatility is actually pretty simple. When does this massive capital outlay translate into proportional concrete revenue?
The sober business reality we have to face is that the era of treating AI simply as a high-margin software play has ended. We are now firmly in the infrastructure reality. The market is demanding concrete returns on investment as structural capacity limits, everything from data center power grids to the supply of rare earth minerals, are rigorously tested. Success in this next phase of the industry isn't just about who has the smartest model anymore. It's about who owns the custom silicon, who can actually retain elite engineering talent, and who can successfully navigate a deeply fractured global regulatory landscape.
Looking ahead, all eyes are going to turn to the Q3 earnings test. Microsoft, Google, Amazon, and Meta are going to have to prove that their massive infrastructure bets are yielding sustainable enterprise revenue. Because if growth stalls there, today's market correction could just be the beginning. That concludes today's explainer. For a deeper, fact-based breakdown of these numbers, be sure to visit our sponsor at bestai.org. Thank you so much for joining us. But I want to leave you with this final thought. As the era of cheap AI ends, is your portfolio prepared for the infrastructure reality, or are you still betting on the software hype?